Welcome to Catalysts. I'm Julie Hyman. We are 30 minutes into the U.S. trading day, so let's get to the three catalysts we are watching this hour. First up, soaring bond yields, spooking investors with markets keeping a close eye on deficit risks. We break down what it means for your portfolio. Plus, we'll talk about the latest in Washington and what changes we could expect to see in the tax bill. Will any ease investor concerns? And we get a read into the state of the luxury consumer amid an overall slowdown for the sector. Are there any silver linings? One retailer signals there might be. We'll discuss that and more on Catalysts. Half an hour into the start of U.S. trading, let's get a check on the markets here. First, we start with the major equity averages, where we're actually seeing a little bit of a gain here. The Dow right now up nearly 20 points, the S&P 500 up about a fifth of 1%, the Nasdaq up about 0.7%. You know, on everyone watching what's going on in the bond market, which we'll get to in a moment, but also we did get some economic data this morning. S&P Global's PMIs, Purchasing Managers Index, manufacturing coming in better than estimated, services coming in better than estimated as well. Manufacturing was expected to contract. Instead, we saw a reading that showed expansion. Existing home sales just coming out in the past few moments as well, showing a drop of 0.5%. But it looks like maybe those PMIs helping matters this morning as well. But let's talk about what's going on in the bond market. As we saw, the House pass the version of the tax bill, now goes to the Senate. We have seen yields continue to push higher here. The yield on the 30-year going up to 5.13%, which has been causing, in turn, some consternation in the equity market. We'll talk more about that. And finally, we're checking on Bitcoin, which is rising, or earlier rose to a new record, closer to 112,000, still higher on the day, but still a little bit under 111,000 at this point in time as we continue to see regulation ease on cryptocurrencies. Well, the House finally approving President Trump-backed budget bill, sending the legislation to the Senate after two tense all-night debates. For more on this, our own Ben Worschel has been monitoring all of this. So, Ben, what are the areas ripe for changes when the bill gets to the Senate? What should we be watching?
Yeah, morning, Julie. There's about 4 areas that I think this week have emerged as especially ripe for amendments coming in the Senate. And the Senate has promised they're going to change this bill. First one is the SALT deduction. This was a last-minute conversation. This was a last-minute concession by Speaker Mike Johnson to GOP blue state representatives from states New York, New Jersey, and California. It's notable that there is a total of 0 senators, that was 0 Republican senators from those 3 states, and it's emblematic of a lot less support for SALT overall in the Senate. So Thune has already said, he's already told Punchbowl News his chamber could have a big problem, quote, with that provision. So there's could be changes there. Others around Medicaid. Another last minute change was to increase the stringency around Medicaid, potential Medicaid cuts. This has an outsized effects on red states. One senator in particular, Josh Hawley of Missouri, has already noted that he has 1 million voters who are on Medicaid and can see their coverage threatened. He's talked about bringing that back, perhaps even eliminating Medicaid cuts altogether. Another one is green energy credits. A similar dynamic here. Republicans don't tout this, but a lot of Biden-era green energy credits have an outsized effects in red states. They help with Republican senators like them, even if they don't like to talk about it. And there's a range of senators who have talked about bringing that back. And then a fourth smaller one, but closely watched by the business world, is around AI. There's a little provision in there that would ban states from regulating AI for the next decade. That's one that Marsha Blackburn in the Senate has already kind of poured cold water on this week, saying she has a law in her state around artist likeness in AI that she likes and she wants to keep. So she may push for a change there. So that's 4 areas that are going to be focused. As for overall investor concerns here, 2 of these provisions would make the bill more expensive. One would make it cheaper. And one I don't think would have any effect on it at all. But it doesn't change the overall parameters here, which is this is a bill that's set to add $3 trillion or more to the national debt over the coming decade. So those investor concerns aren't likely to change depending on what the Senate does.
Ben, those various items of contention, what does that mean for the timeline for the bill?
Yeah, so Speaker Johnson reiterated this morning he wants this to the president's desk by July 4th. President Trump said the same thing in a Truth Social post. I think that's ambitious. There's going to be a back and forth here. Obviously, any change that happens in the Senate would have to get approved again in the House. So there's going to be a good amount of back and forth here. The real kind of crushing deadline is the debt ceiling, which Treasury Secretary DeBesant has said needs to be addressed and is in this bill by the end of July. So that's the motivating deadline, I think, on all sides to get this done is before the August recess. So that's what I think people are watching, depending on how much back and forth there is between the House and the Senate.
Ben, thanks so much for keeping us abreast of everything going on. Appreciate it.
Sure thing.
Well, the bond market is pushing back against that Republican budget bill, which is expected to add trillions of dollars to the U.S.'s already ballooning budget deficit, as we just heard. Joining me now on this, my guest host for the hour is Jeremy Schwartz, WisdomTree Global Chief Investment Officer, and we have Anthony Saglimbeni, Ameriprise Financial Chief Market Strategist. Guys, thanks so much for being here. Jeremy, I'm going to start with you. As Ben just talked about, whatever version of the bill gets through, it's going to add to the deficits. We've been, those of us who've been around a little while, we've been hearing this for a long time. The market is concerned about this. But what's the tipping point, if there is one?
It's a very interesting question. What yield level gives the market the real big indigestion? When we came in, and we were a little cautious earlier in the year, saying there's a risk that the 10-year could get to 5%, and that would be one of the big pressure points for the market. So you had some of the recession fears, the tariff disruption was sending yields back down. Now global yields are rising, everywhere yields are rising. You're seeing this week, bonds have been this classic risk-off diversifier hedge, but not this week a little bit. Yields are rising and you had a bit of pressure in the market. So you're getting close to that level where a big move in yields higher is one of the big pressure points for the market.
And Anthony, what do you think? Do you think that this move in yields higher is going to stick around?
Yeah, I absolutely think it's going to stick around. I think the market is sending a very clear signal that the deficit spending that has gone on for years and continues in what is a pretty healthy environment from an economic standpoint is going to likely influence rates higher for the foreseeable future. And I agree with Jeremy. I think when you get to a 5% level, I think we would, or when we're starting to approach potentially a 5% level in the 10-year, I think you would have equities have a much harder time with that yield because of the discounting of future earnings becomes more expensive. And those types of things investors, at least from the stock perspective, are looking at right now. And when you have tariffs, slower growth, profitability that's likely to come down for S&P 500 companies over the next couple quarters, it just adds to the stew of uncertainty in the cost of doing business.
Well, let's talk about valuations first. Let's linger there for a moment, Anthony, because I know you're looking at PEs, which had come down, of course, as stocks had come down. Now they're back up again. As you can see from this chart here, I know this is a chart that you're looking at. So given the uncertainties you outlined, given yields where they are stocks expensive right now?
Yeah, I mean, I think stocks are fairly priced to elevated based on the macro environment today. And as that chart shows, in early April, there was a reset in valuations that allowed an opportunity for investors to look at some of the sectors that had run very high over the last couple years, technology being one of those areas, to get a better price to earnings, price to cash flow, price to sales, if you were a longer term investor and you could look at some of the opportunities. I think where we stand now, the S&P 500 is trading at about 22 times this year's earnings. So the stock market overall is not cheap. Some areas of technology still offer opportunities based on their longer term valuations, but that opportunity gap has narrowed. And so now investors have to probably be a little bit more discerning about where they're investing in the market today.
Jeremy, what do you think? Oh, sorry. Go ahead, jump in.
Yeah, I think, Anthony, when you make this comment on the valuation, we've often talked about at WisdomTree sort of fair value long-term being 20 times earnings. If you go way back, all the data, Bob Shiller's data, 150 years, says like 15 times earnings is the very long-term average. But why is 15 the right number? We say 20, given where we are in the economy, the cost to get access to markets come way down. There's a lot of reasons to say 20 is fair value. So you are a little bit more elevated than that, but now it all comes down to the earnings outlook and can you deliver? Certainly the tech stocks, the Mag 7 are like 30 times earnings, and they deserve a good premium multiple because they're growing much faster, but every one has different risks from Apple to Nvidia to Alphabet, like really a value stock now. There's just each one has different execution risk, but it's you could say deserving of the higher multiples. They're growing faster.
Well, and I guess, Anthony, to get back to you then, how do you decide when a premium is worth it on some of these stocks? Like, what sort of criteria, how are you thinking through it in this particular moment and macro environment?
Yeah, I think Jeremy's right. Longer term, 20 PE multiple for the S&P 500, and we're a little bit above that. But to the point made earlier, a lot of earnings growth is coming from big tech and Magnificent Seven. And what we saw over the earnings season over the last couple of weeks is that the AI theme, the hyperscalers, the money that's spent on infrastructure and chips, all of that remains intact. So we'll get Nvidia next week. That'll be a very important earnings report. But it's very likely they're going to at least meet to maybe overachieve on the earnings estimates because that longer term secular theme of earnings growth remains intact. I think for the rest of the market, things like tariffs, slower growth, some of the cyclical areas that are exposed to technology, those are the areas that are going to likely have to prove that their valuations are warranted right now, particularly if the economy slows in the second half.
You know what? I'm going to jump in here and linger, Jeremy, on Nvidia for a moment because we are obviously paying a lot of attention to it. People love checking Nvidia on Yahoo Finance. It's one of the most followed stocks. What do you think that report is going to bring, not just for Nvidia itself, but for the market?
And that's been like the key focus stock for the whole market because so much of it is AI driven. They are the key AI stock, and they got as high as 150 in April. They bottomed in the a little bit below 90, so huge volatility. And it started after DeepSeek, the big news in the China AI. Would you need a lot less chips to really commoditize AI usage? That was a big 20% down in a day, and it's rallied back. You look at the data center demand, it's not going away. Everybody talks about, I've seen some stats that data center demand is growing 50% a year. And so now the question is, can you just do so much more with their chips? And the technology is exciting. I think your early days of AI, people using it, getting applications built on top of it. So there's an element of where we're just starting. Google just released AI mode last night, so they're just starting to have new applications of this. And so, you could see a lot of continued runway, but the question is, will we get a technology that lets us use a lot less Nvidia chips? Is the holy grail question that we'll see over the next few years.
Probably not answered next Wednesday, though, when we hear from the company. Anthony, finally, I want to ask you about another theme that has been bubbling up a lot, and that is international, right? And this sort of movement out of the U.S., or if not out of the U.S., at least to add to international holdings. Is that something that you're recommending for clients also still? Do you think that has more to run?
Yeah, I think international, obviously a well-diversified portfolio across equities makes sense. We're slightly overweight the U.S. because of the themes that we've been talking about around technology and AI. The U.S. is best positioned on that theme, so we have a slight overweight. But we're also overweight areas like Europe, right? There's more defense spending coming from the Eurozone and countries like Germany. Their inflation rates have come down. The ECB is a little bit more active in terms of lowering interest rates and supporting growth. Inflation has come down a little bit. So there, and the valuations are much more attractive for some of the cyclical areas of Europe. And so in an environment where the global economy avoids a recession and investors can feel a little bit more comfortable about putting cash to work because there's a lot of cash still left on the sidelines, I do think Europe and international are one of those longer term opportunities where investors can kind of turn to.
Anthony, thanks so much. Jeremy's going to stick with me for the hour. Up next, we're taking a look at some trending tickers. We'll give you the news behind the moves on Catalysts.
Our Nvidia number of the day, $162. That's the median analyst price target for Nvidia shares, and that's nearly 20% north of the current share price. But what does this number actually represent? It's a blend of expectations about Nvidia's growth, profits, and market trends. Investors often use these targets to gauge Wall Street sentiment, but remember, targets are not necessarily guarantees. Big event on deck. Nvidia reports first quarter earnings and the options market is already buzzing. But what should investors expect from the stock after the report drops? I'm Jared Blickery, host of Stocks in Translation. First, the big picture. Historically, Nvidia's stock reaction is a mixed bag, but leaning bullish immediately after earnings with median gains of just 2 to 4% over the first month. But then watch out, the stock tends to blast off, about 18% historical gains by the end of the quarter and a whopping 117% return 1 year later. And the longer you hold, the better your odds. A positive outcome happens about 83% of the time after 1 year. Now let's zero in on the AI area. This is the past 10 reports, so artificial intelligence has been the name of the game, stretching back 2.5 years. The stock's next day pop has averaged nearly 12%, but the options market is only pricing in a 7.4% move after the report. That means traders might be underestimating the impact of Nvidia's earnings. But outside of earnings, Nvidia's typical daily move is only about 4.5%. This means earnings days are 2 to 3 times as volatile, and here is the scorecard. 6 big wins with an average gain of 11% over the last 10 reports against 4 losses with average dips of about 5%. Basically a coin flip, but the wins have paid much bigger than the losses. And if you're a long-term holder, here's your rolling gauge. Nvidia's 1 year returns measured from each earnings date are currently at all-time highs. Multiple years have posted gains over 100%, with only brief dips below zero since 2010. Momentum clearly favors patient holders, but this number has dipped below zero before, so there are no guarantees. And the bottom line for traders, expect wild short-term swings, but over the long run, Nvidia's trajectory has tended to be up. And here's a pro tip. Given history, options might actually be cheap here, so volatility buyers take notice. Well, Nvidia's report, will it extend this incredible streak or will it break the trend? Stay tuned. And tune in to Stocks in Translation for more jargon-busting deep dives. New episodes on Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcasts.
Thanks, Jared. Appreciate it. Now time for some of today's trending tickers. We're watching health insurers, advanced auto parts, and solar stocks. First up, let's talk about health insurance stocks. The Centers for Medicare and Medicaid Services announcing an expansion of Medicare Advantage audits. Humana is taking the biggest hit of the big insurers. It's down about 4%. United Health down slightly, but of course it has been tumbling as of late. CVS down a little more than 2%. This increases and broadens the scrutiny that these plans had already been under here. United Health, some of its plans under investigation. Jeremy Schwartz is still with me here. Insurance stocks, obviously it's been led mostly by United Health, but it's been a tough slog for many of them.
Yeah, United's had all sorts of idiosyncratic stories with the CEO issues as well. They came under fire also from Trump when he talked about trying to cut prescription drug prices, these big numbers like 30 to 80%, and it's like the pharmacy benefit managers, the PBMs, are for United a bigger source of revenue than for Humana, but it's as much as a third of their revenue might come from some of these PBMs, and who's going to be hurt if they actually can avoid some of the PBM managers that's trying how they lower the prices. They are coming under attack from that element within the administration.
Right, so it's sort of multiple fronts at this point when it comes to the regulatory scrutiny of these companies. Next up, we're also watching advanced auto parts. Those shares are soaring after the company reaffirmed its full year guidance. The car parts retailer also topping first quarter expectations. The CEO says tariffs have created a, quote, highly dynamic economic environment, but the company is expecting to make progress on mitigation options. Now, I don't know about you, Jeremy, whenever I see a move like this in response to earnings, which seems so outsized, I go straight to short interest. And indeed, advanced auto parts, according to Bloomberg data, has about 18% of its float is shorted, which is high for those of you out there. So you could be seeing a short squeeze in addition to whatever underlying move there is.
Yeah, you think about some of the prime stocks that are at the risk of tariffs, and car parts have been a key discussion. If you have these 25% tariffs and where are they produced around the world, this could be one of those key areas. And then you get the actual results. And now, it's we haven't seen the actual tariffs yet, right? The tariffs are just starting to come in, and you'll start to see them from, the next few weeks is actually when you're going to start to see some of that. But it's one of those stocks that was prime focus, hit because of that expectation, but you beat earnings and your depressed earnings,
off
and
to the races.
Goes higher.
Yeah, I mean, this company has been trying to turn itself around. They've closed some poorly performing stores. Comparable sales still fell by 0.6%, but that was a lot better than the 2% decline that analysts had been anticipated. And finally, let's look at solar stocks. They are falling after the House passed that tax bill. It terminates key clean energy credits a little bit sooner than had been anticipated. The legislation ending those tax credits for installers that lease equipment to customers. Some analysts call the bill worse than feared. Now, they don't phase out right away, but they will phase out sooner than had been anticipated if this bill goes through as this current draft is showing here. You see Sunrun taking a tumble 38%, Enphase down about 15%, SolarEdge down about 25%. Now, these companies sit at different parts of the stack. Sunrun is the installer. Enphase, its equipment basically helps transmit the solar power through batteries into the electricity of the house. SolarEdge also. So they sort of are affected differently depending on where you're looking. We could see changes to the bill, as our Ben Werschel said earlier. Some of the states that are red states actually have depended on these credits, and that's where the solar companies are. So we'll see how it turns out, but those are big, big moves.
Well, tying back to the lead off of this section, which was Nvidia, what the number one story is AI power demand. What do you need for these chips? You need power, you need energy. So there's this trade where the utilities were trading a lot like AI plays, and you have a lot of the big energy companies needing solar as part of it's not a substitution, it's an and. We're calling it not just energy transition, it's energy addition. You need more energy. So I think some of the case for solar is actually there for the long run. Now, how does the administration support it? What are the credits versus the demand and needs? But whether it's nuclear, solar, natural gas, all sorts of energy, we're going to need a lot more of it.
Right, and to your point there, I was also looking, by the way, at some of the nuclear companies, because there are some provisions in the bill related to them, and we're seeing some increases there. So we'll see how it all turns out when the Senate gets the bill back. And you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Well, coming up, I'll speak to the CEO of Lumen about the company's recent deal with AT&T. That is next on Catalysts. Ralph Lauren topped estimates for revenue and adjusted earnings per share in its fiscal fourth quarter, but as tariffs take effect, the luxury retailer predicts sales growth will slow in the latter half of its fiscal year. LVMH has reportedly been warning investors of continued weakness in demand. That's according to reporting from Bloomberg. Joining me now to put it all together, Pauline Brown, former LVMH chairman of North America. Pauline, as always, it is great to see you. We've really seen interesting indications from some of the big luxury houses, or sort of mid-market to luxury houses. I think of Tapestry as well, which did better than estimated. Big picture, how are you viewing some of these tea leaves that we're getting?
So if there were two themes that define the current market of, as you said, either moderately luxurious or ultra luxurious brands, it's the winners are those that are perceived as good value and those that are purely luxury lifestyle. So what do I mean by that? Ralph Lauren came out today, really had stellar results. I have to say, up high teens in China. Nobody's growing like that in China. But I think the story there that really wasn't told directly is that this is a trading down. Ralph Lauren has almost 200 outlets in North America alone. Discount outlet stores. Prada, by comparison, which is also doing well, has less than 10. Armani has closer to 15. So there's a big portion of Ralph Lauren's sales that are not happening at the purple label level. But the cachet of the brand is still bolstered by that purple label. So Tapestry would fall into a similar camp as Ralph, and they are doing very well. And then you have a few players like Hermes and Brunello Cucinelli. and Montclair that are more lifestyle than fashion, that are also more purely luxury than spanning all the different segments, and that are not that diversified like LVMH and Kering. And in this case, that's a good thing. They're also doing very well, the ones that are less diversified.
When I see, the trends in Ralph Lauren, there's a few questions from where things are produced, where they're being, consumed. It's interesting that North America revenue looked only up like 3%, but Europe up double digits, China up double digits. China's been one of those interesting markets where you see they're competing in things like EV and phones with Huawei, but the branding on luxury items like this, they've got some things like Anta, who's making progress on some parts of clothing, but what do you think about the luxury brands in China? Are they going to be able to compete with their own brands here in China versus like a Ralph Lauren?
So if the question is, do I think Chinese marketed brands are on par? Absolutely not. Not to say that there isn't a lot of talent in China, not to say that the production capabilities aren't very good in China. In fact, many of the luxury brands are already making products in China. In the case of Ralph Lauren, about 15% of their supplies come from there. But the storytelling and the experiential design is not at a world-class standard yet. Why do I think Ralph Lauren, though, had so much momentum in a market that otherwise is treating most of these global luxury brands pretty harshly? I think because it's good value. And I think in an environment where the other brands have really taken price to an untenable level, there is an embrace of those that are still doing quality product and telling good stories and offering good experiences and affordable.
You mentioned earlier, Pauline, that we are seeing a little bit of a trade down effect. And it's interesting because I think we tend to think of the ultra luxury consumer as, unassailable, right? That they're going to spend no matter what. But what are the nuances within that might cause a sort of trade down effect?
Well, first of all, the real trade down activity is not that ultra affluent consumer that we're talking about, that top 0.01%. You're right, their behavior doesn't change radically. If anything, they're moving more and more away from the middle and more purely to the Loro Pianas and Hermes of the world. But the majority of the market is what we call aspirational. And that aspirational segment is price sensitive. And so I think for those brands that have made a good case by creating nice store environments, you'll notice in the case of Ralph that their growth was largely driven by direct to consumer. The wholesale, where they can't tell their story quite as richly, that is not doing so well. But where they are, executing well, the customer, and I'm talking about this more mainstream affluent, but not ultra affluent customers, responding really positively.
And of course, some of these aspirational brands are still getting to consumers through department stores, even if that is maybe a waning channel. We've got Nordstrom going private. We're going to hear from Macy's, which of course also owns Bloomingdale's, next week when it reports. What's the role of the department store at this point?
Well, it's been a weakening channel for decades now. And I'd say that's even more acutely the case at the high end than in the moderate price. And what you have seen at every level of luxury is their move more and more to opening their own standalone stores. The reason, though, that some of these more capable department stores are not going away, they may continue to erode, but they'll be here for a good while, is because the consumer still wants a multi-brand shopping environment. There are very, very few consumers who will go into a standalone store and say I want everything head to toe, from the perfume to the shoes to the bag to the dress. Most of us shop in a way that's more reflective of our closets. And so the idea of a multi-brand store is still something that is in keeping with the way consumers want to shop, but the delivery of that multi-brand proposition has become very challenging. I would also argue that multi-brand retailers like Macy's have just gotten so large and so expansive that they've almost over-assorted for that same customer. The ones that are really winning right now are more curated.
Pauline, one of the things, when you think about the retail and consumer, I think one of the interesting stocks recently has been Walmart. It's sort of the opposite, you could say, maybe of just this luxury brand. But Walmart, when I look at the valuations, selling at a PE higher than Amazon. Amazon being viewed as this, not just the retailer, but the tech side of things. anything you're seeing in sort of Walmart versus Target in the sort of general consumer where they're going shopping?
Yeah, I mean, I think Target, as has been, I think, become increasingly evident, has lost its way. So Target could never compete with Walmart on scale and on resources. But for a long part of its history, it was competing on brand, on store experience, and on values. And I think most recently that store's retrenchment away from a set of values that came to define a more progressive store and a more progressive culture has backfired. So if you're just going to play on price, game over. Walmart wins in terms of the bricks and mortar world. But if you're playing on a combination of price in conjunction with another set of experiences and connections with the customer, then that Target still had a play. So I think Walmart here is a beneficiary of some of Target's issues. And I could say the same about Kohl's as well. Kohl's, JCPenney, many of those that had been chipping away at Walmart for a number of years are now quite a bit weaker at leaving the space wide open for an already very strong player, which is Walmart.
Pauline, always good to see you. Thanks so much for joining us.
Thank you.
Got much more markets action coming up. Stay tuned. You're watching Catalysts. Lumen Technologies is selling its consumer fiber to home business to AT&T for $5.75 billion in cash. It's part of the company's effort to focus on its enterprise strategy. For more on this, we've got Lumen CEO Kate Johnson joining us, and I'm also joined by Morning Brief co-host Brad Smith. Kate, thank you so much for taking the time to talk to us this morning. So, selling this business to focus on your enterprise business. Talk me through the thinking on that and how this will allow you to do that.
Thanks for having me on the show, and happy to announce it's a new day for Lumen. The thinking behind the deal was quite simple. Every company on earth is leaning into AI. It's become a mission-critical technology for any business that wants to transform, that wants to innovate, that wants to compete and perform in this environment. And we have a right to win with assets to support those companies, which I can talk about more in a minute. I think there was another trend that we were looking at very closely, which is the convergence of the demand curves for fiber and wireless in the consumer space. And AT&T has the scale, the brand, the footprint to really compete and invest in that business. So we chose to double down where we have a right to win and sell the business to AT&T on the consumer fiber side and retain our ability to really serve the enterprise.
You know, I wonder in the talks that you've had with the executives over at AT&T, I've had the opportunity to speak with the CFO, Pascal Desroches, in the past. And in the most recent weeks, when I was discussing with him their plans for fiber, where did it ultimately net out and become clear that this would make sense not just for AT&T, but for Lumen as well?
Well, I mean, if you look at the deal, Brad, it's actually great for us. $5.75 billion. When you do net proceeds after tax and you add some cash on hand, we can reduce debt by $4.8 billion and delever the company from 4.9 to 3.9. And that's just getting started. We retain all of the assets on the copper side in the consumer, wholesale, and enterprise space. They have meaningful cash flow and contribute meaningfully to our overall financial health. So we can continue to use those dollars to do whatever we wish. We have financial flexibility now. We can pay down debt. We can continue to digitize and streamline our operations, or we can start to think about acquiring new capabilities to serve the enterprise.
Kate, talk to us a little bit about your enterprise customers. If you can tell us who they are or what kind of enterprises they are and what the growth opportunity looks like there.
Sure. Large enterprise on the commercial side, the mid-markets, we serve public sector, all of them, okay? All of them in North America, multinational corporations as well, and our network is proximate to so many of them because it's huge and it comes close to touching them. They all share a common problem. AI is all about huge data processing needs, right? And there's a lot of complexity in the network architecture of today. You've got on-prem, you've got edge, you've got data centers, you got multiple clouds, and you got to serve the data to the most efficient place to do the compute. which means you need a network that can support it. And legacy networks, they're not big enough, they're not fast enough, they're not secure enough, and they're not intelligent enough. So we're fixing all of that with our physical network and a digital layer on top to make it easy for any enterprise, public sector or commercial, big or small, to use network to leverage AI.
With all that in mind, with the proceeds from a deal like this, how do you see kind of building out the future for the business, which investors have really been trying to wrap their minds around over the past couple of years, as evidenced in some of the stock price fluctuations, and knowing how much capital has to get infused up front in order to bring that scale to fruition?
We have a digital platform in place already where we provide network as a service to these customers. This is cloudifying telco. So take traditional transport mechanisms, whether it's IP or waves or Ethernet, and now imagine giving customers the ability to fire up any port with any service, anytime, anywhere. That's cloud consumption. That's the way they're used to thinking of these capabilities, and we're giving it to them now. But we're also investing in data protection services and security services that we can layer on that digital experience for them. So we have this amazing ability to scale the services that we sell, to scale the revenue in the enterprise space, and provide it with cloud economics, which means the marginal cost to serve these customers continues to go down. We're just at the beginning innings of this new phase of imagining the future of networking, but we've made incredible progress and the future is incredibly bright.
How much of that networking do you believe continues to stay on the ground, on premise, and in some of these cloud data centers versus what's getting sent up via satellites into skies, as we're seeing that also being prioritized on the other side of communications?
So I think any enterprise needs to have a fulsome strategy in terms of how they're going to transport data. If they've got remote locations, you know, you could go anything from fixed wireless to satellite to 5G. And when they think about transporting, you know, data needs to find fiber as fast as possible. So we're very comfortable with our role, no matter what those technologies on top do and how they evolve. Data needs to find fiber as fast as possible, and we've got the best fiber network.
Kate, thank you so much again for taking the time. Brad, thank you as well. And we've got a programming note. Thank you. Yahoo Finance is going to speak with AT&T CEO John Stankey about this deal and much more. That's coming at 3:15 p.m. Eastern. You don't want to miss that. Coming up next, we're going to sit down with the CEO of running app Strava. That is coming up when Catalyst returns. Fitness app Strava, which has more than 150 million users globally, closed its latest fundraising round with a valuation of $2.2 billion. Strava announced its acquisition of Runna and The Breakaway as well. Joining us now to discuss how the company's putting that funding to work, Michael Martin, Strava CEO, Morning Brief co-host Brad Smith, avid fitness guy, is also with us here. Mike, thank you so much for joining us. I am a Strava user, I have to admit. I use it to document my hikes specifically. So how are you guys, as you do this new fundraising, what is the goal, what is the plan for expansion?
Yeah, thank you, Julie. Thank you, Brad, both for being customers, but also for having me on. So Strava is coming off a year of historic growth. So we saw 50% year-on-year growth last year, and Q1 of this year is actually growing even faster. That growth has given us great opportunity to look at across the fitness industry as a whole and try to think about how we can better serve consumers across all different sports. So you're right by calling Strava a fitness app, and that you both have different ways that you engage with it. We support 50 different types of fitness. Right now, running is booming, but Julie, hiking is building up quickly as well. And we went and did this round specifically so we could not only build upon that organic growth, but we could have the opportunity to go and add in some best-of-breed offerings that further deepen our ability to support many different types of sport.
Michael, as people who engage with Strava, and also you have an overlap perhaps in that Venn diagram of potential future investors as well that would love to see this company be publicly traded here. What does this funding do towards getting Strava more in that realm or the mindset of potentially going public?
Well, We're in a really unique situation right now. Not only is the business profitable and has been profitable for more than 4 years now, the free cash flow continues to grow substantially. And that put us in a great situation to be able to both do this round, but then also draw upon those cash reserves and do a little bit of tactical debt financing as well with JP Morgan Chase and Wells Fargo. Combining those three things together gave us a great cost of capital and a way to pursue our plans. In terms of something like a future public listing, I would just say that the future is extremely bright for us right now. I wouldn't rule that out, but I don't think we need to do it at this moment in time. I do think as we continue down this path, all kinds of opportunities like that become more and more certain.
And Mike, talk us through a little bit more about, you talked about your profitability. Talk to us a little bit more about how you make money. Of those 150 million users, how many of them are paid users? Because I know you guys have that sort of freemium model. And what are the other sources of sales for you all?
Yeah, happy to. We don't disclose subscriber numbers, but subscription represents the bulk of our business. Almost 90% of our revenue comes from subscription. I'm really excited. This valuation is for, just to be clear, is for the Strava standalone business. So it's post-money, but pre these acquisitions. With these acquisitions and the growth that they're seeing as well, we expect to hit a ARR of $500 million in the short-term foreseeable future. And that gives us great opportunities to continue to move forward.
As you think about what other running and apparel companies have said, and running being recession resilient, I wonder how you're seeing that play through from the platform perspective too. Do you sense any kind of hesitation from users who might still be running, but may not be paying for as many features as they would have been in kind of, more free-flowing cash times, and how that ultimately translates to a better kind of baseline and forecasting for the business?
Yeah, so one of the things that I've learned in this industry, not just in the 18 months that I've spent here in the CEO role at Strava, but also in my time at Nike, is that sport is a long-term secular tailwind. It's continuing to grow on a global basis and has no signs of stopping in the foreseeable future. What shifts, though, is trends between sports and demographic trends. So like right now, the big boom in sports on a global basis is in running, and specifically with Gen Z women. And that's happening here in the US, but that's also happening at massive scale across Southeast Asia, across the global South. That flexibility between different sport categories, some of which require more money from the consumers, some of which are, far more democratic and less equipment required, allows us to shift and move between them. But to go back to Julie's question, we also, besides the subscription business, have a sizable and growing advertising business through sponsored challenges. And this gives us sort of dual engines that we can use to make sure that our growth continues to be steady and predictable through the business.
And Mike, one of the interesting things about Strava is that it's not only a tracking app, of course, it's also it has a social media element, right? You can see your friends, you can connect with people you don't know. Talk us through that angle of it a little bit and kind of what functionality that brings for users.
Yeah, totally. We definitely have social features, and it is a social app. I don't think of it as a social media app, because social media apps are about keeping you locked in the app and spending as much time there as possible. Strava exists to make the whole world active. So our goal is to get people outside of the app to go and motivate them to go and do an activity, go for a hike, go for a run, get on a bike, go for a swim. The community and the social features are all designed very, very finely to help motivate you to be more active. And that is a very unique and uniquely positive aspect of the internet, which makes Strava a truly unique internet platform, because it's a place where you can go and get that sort of recognition and motivation in a helpful, positive, supporting, and encouraging way. But it's never going to be one where we turn it into a full social media network. Those features are really about motivating users to be more active.
Mike, real quick, what's your sport on Strava? Are you a runner?
So according to A Year in Sport, my top sport is running, following that cycling and swimming.
Wow, all of the above. All right, Michael Martin, thank you so much. Strava CEO, and Brad Smith for joining me as well. And for more private company data, you can scan the QR code below to check out Yahoo Finance's private market data. You can check out valuations, funding rounds, and more. So with me, Jeremy Schwartz, patiently waiting in the wings here, WisdomTree Global Chief Investment Officer. Jeremy, wanted to get some final thoughts from you here as we see, the stocks kind of, muddle along here, if you will. Not much changed on the day. What is the sort of next big catalyst that you're looking for?
Clearly, the market's very focused on two key things. It's the tariff news and then this sort of policy framework of the debt and deficits with the interest rates. The market's gotten comfortable with what we call the 10-30, sort of 10% baseline, 30% on China. And so the question is, where do we move from there? If we get any upside surprises, will tariffs come down? That's another positive catalyst. And then if interest rates blow out because there's fears about the deficit and spending, we don't actually bring down spending and deficits keep going higher and higher, that's one of the other downside risks. But I actually do think I'm more optimistic in that. I think we actually can get some upside to tariffs not being where we are at the baseline today. And so I think my general take is to be more optimistic here.
And on that note, we leave it. But I like that, leaving it on an optimistic note. And big thanks to Jeremy Schwartz of WisdomTree. Thank you so much for hanging out for the hour. And coming up is Wealth. Stay tuned.